Okay, 1400, let's crack on. I'm going to do, I guess, an abbreviated market roundup because I've gone through the whole list today and there's absolutely sweet FA going on at the moment other than equities and the things that are linked to equities. So I'll just cut to the chase. That should shave off a good 20 minutes of nope. Then we'll go through a bit of macro stuff because every now and then I like to, I guess, check myself before I wreck myself and go back to the bare bones of, or basically re-interrogating the data set from which I make my opinions. And that, for me, is probably the healthiest habit I do on a regular basis in anything, really. Whenever I'm feeling uncertain on whether it's markets, relationships, whatever, you must re-interrogate the data set from which you base your opinions on. So, without further ado, let's crack on. That's stock. All the other stocks look the same. So J30. Let's go back on the daily chart. The FTSE is now finally sort of got its running shoes on and it's trying to catch up, but it's attacking this 6,500 level, which probably may or may, I don't know. Honestly, there's not much point looking at technicals at the moment on the indices because there's so much going on behind the scenes. It's literally whatever's moving the markets is moving the markets, and technical analysis isn't going to show us much on the indices just because there's so much stuff going on. Elections, the Fed, which is why I did another sort of deep dark look, another sort of reanalysis of why the hell do I think what I think. So, as you can see, my little doodles looked really well until we got to this line here, and I thought it would bounce off this 3,400 level, but it didn't. So, obviously, there's one side saying that Biden wins, it's going to be a huge amount of printing, yada yada yada, and everyone's sort of going long on the hope that mass stimulus is coming, but stimulus won't happen for a long time because Biden won't be president until what is it, January time. So that's a lot of there's a couple of months of no stimulus basically, and plenty of time for the markets to crash until then. So which is why when the Fed came out with this the other day, I had a little look-see. So it released its financial stability report. If we zoom up, here we go, November 2020. Pretty new off the press. I believe it came out about a week ago. And to be honest, it's not the hardest of reads. And when I say that, you can be relatively uninformed about the markets, etc. And it's it's not that hard a read. So it's probably worth. I'll put it in the link. If you're really bored, I didn't say it's interesting. It's just not hard to read. It's a very boring, easy read, if that makes sense. And the thing that, and when I was going through some of these charts, I was that's interesting, and I couldn't actually find some of the charts they have in their own report on their own website, which is fascinating. Whether I didn't look well enough, but it got to around this page here, which I found quite interesting, and then this was actually this page that made me have a look because it's talking about house prices, etc. And I thought, okay, let's go back to the drawing board. So I've had to just screenshot these and then just put them in my little doodle pad and then sort of blow them up. As you can see, there's not much fidelity in this resolution, but so I thought I'd categorize things a little bit into cause and effect, whereas a lot of people look at things and they think, oh, it's all the same thing, but there is an order, there is a hierarchy to graphs, and I think you all know by now the most important graph on the planet, which is MV, but yeah, enough of MV, you've heard enough about that. So let's have a look at the cause. So over here, this is actually the chart I couldn't find on their website. So it's the change in banking standards for commercial real estate loans. But I did find this one as well, which is the same chart. However, it's the net percentage of domestic banks tightening standards for commercial and industrial loans to large and middle market firms. Okay, so in a nutshell, this is basically the banks tightening their arse, so to speak. So if you look down here, so in this phase it's easing, so cheap, easy credit. Up here is tightening, and it's the same thing over here. So on this chart, when it gets above this zero line, it's tightening, and then it gets down here, it's cheap, easy, free money. So what happens? So let's have a little look-see from what happens around sort of 2000. So remember, the banks and the Fed, etc. The commercial banks, they are really what the smart money is. They see a lot. They're the ones that are issuing all the loans to everyone. They have a finger on the pulse. Okay, they know what we don't. Okay, they see everything. And so in the run up to the 2000 crash, they started tightening up, as we can see here on both of these charts. In fact, I'll just draw these. Where's my little pen? Make it thinner. So on the run up to here, lots of tightening, okay? And why is that? Remember, a bank is a business and they need to make profit. They see the writing on the wall. They see that there's huge instability in the market and something may happen in the markets, and so they just don't want to lend to anyone. So and it's very similar to what's happening now. They tighten up their lending criteria, and they actually only end up lending to good, solid businesses. And that then forces the Federal Reserve's hand. So what happens is that the Federal Reserve goes, shit. So the Fed, the only thing the Fed really can play with is the Fed funds rate, i.e. base rates. Let's just call this base rates. And the other thing they can do is print, effectively, okay? Or print/credit. That's pretty much all they can do. So what happens is the Fed tries to use base rates, or the Fed funds rate, to try and force the bank's hand. So the banks go, things are looking tight, don't want to lend, I don't like giving money to homeless people, that's, whatever. And so that's the cause, and then the effect is, shit. So the Fed can only do one thing, really, to stimulate. If we had a chart of, credit, you'd see, the chart do this, basically. We've all seen that chart. But what happens is that it forces the Fed to drop rates. So it dropped them from about 7% all the way down to, 2%, hoping that it would give the banks, the commercial banks, more agreeable rates, so they start lending, so they can start kicking off the economy. In fact, this is probably where we do need the chart of the Fed velocity. Here we go. So what happens if we look at this? In fact, screw it. Let's try and squeeze on this chart. Okay. It's gonna be one messy page. This. Here we go. Something like this. MV. And MV is actually up here in the cause. I guess it's both. MV, money velocity, is actually a cause and effect at the same time, because it's like this. Let's just hover it in the middle, okay? So let's go back to the what's happened here. So as you can see, this is the year. Where's 2000? Jesus Christ, kid. Here we go. Here's 2000, and so MV starts to drop a bit, and so they're like, okay. And the reason why it's dropped is because the banks have tightened lending, which means when they're not issuing as many loans, the currency creation actually slows down a bit, which is technically monetary deflation. And I guess actually, if you look at this, what happens when the tightening happens? Guess what happens to the stock market? Stock market goes down, and actually that's probably one of the causes for MV over here. If we just actually move MV over here, So big, Enron goes bust. We have the tech bubble pop, etc. Everything goes down, and so they keep on then trying to lower it a little bit by little bit by little bit, and meanwhile they're printing like freaking crazy. But what they're also trying to do, which is why this chart is so important, this is the real estate lending criteria. What happens is over time, you can see here that they then dropped lending criteria once we're out of that sort of tech bomb bubble popping, and then it got into real cheap, easy credit around here, around 2003-ish. And guess what happened to commercial real estate? So it started a boom. So that, I guess, that's going back to 2000. Then we had this pretty much exactly the same thing in 2008. So on the run up to 2008, all the banks knew the writing was on the wall. They're like, shit, yeah, let's stop lending because it's just ridiculous. Guess what happens? The Fed goes, shit, we need to drop rates again. And you can see it bounce. It only sort of got to high about 5%, and then they had to drop it down to 0. And what happened? We had the subprime mortgage collapse. We had the 2008 crash in general, or the credit crunch. MV then dropped even faster, and then 2000. Obviously, house prices dropped big time in 2008. Okay, but remember, whilst all of this is going on, what is the overall cadence with the Fed funds rate? It's down. It's this diagonal line down. And every time they lower it and do all of this stuff, they're losing leverage on one of the only pillars and levers that they have. So fast forward to now. I mean, the writing was on the wall. Like COVID or no COVID, this was always going to happen. What's happened is right now, look what's happening to the Fed banks. The banks have tightened like crazy. Not as bad as 2008, but it's pretty freaking bad. And so what's happening is that, look at this, the Fed has had to drop rates again, and this is another reason why I'm still positive that we'll see negative rates. They can only do so much. And negative rates, they just want to force people to not save, and they want to force people to actually spend it, so they can try and rectify this MV train crash over here. And so, guess what? This is another reason why I think we have at the very least, a stock market crash back at, to these highs before we see any proper big rallying. I know everyone is thinking Biden is going to do this, but people, a lot of people do get caught out when and that's mainstream thinking right now. Mainstream thinking right now is, Biden's going to win, mass stimulus, yada yada yada, it's going to go to the moon. And you have to always question yourself and worry when that happens. I think this is probably more likely. Just looking at history, I think that's the only thing that can happen. Now we may don't get me wrong, we may have a blow off top, which is pretty much what I think is happening right now. But I have re-interrogated my data set, and I'm still coming to the same freaking conclusions. Not only that, if you go back to my macrometrics video, there's we still have all of the other bollocks going on in the world, which is the whole world of small businesses being absolutely bent over and buggered, basically. Sorry, I need better language. I apologise. My wife tells me off. It's something I need to work on. So yeah, and everything I've just mentioned right now is like without COVID. Like when you add in all the COVID bollocks and the lockdowns and the business going bust, like everything, it just adds more shit to the fan. So, ladies and gents, I think I'm still certain, or no, I'm still very, very confident that we're going to see further falling. I just don't know from where it will fall. That's the thing which I can't pinpoint. Simply because TA has gone out the window. Like, where, from what point is this, this collapse going to start falling from? And it could be here, or it could be somewhere from up here, like that. We don't know. Remember, everyone's sort of thumb in bum mind in neutral at the moment, thinking, oh, everything's going up, my stocks are doing great. But I'm just cautious. That's all I am. I'm tentatively cautious, and I really, really want to just smash in some big old shorts, but I think best bet is to wait. If you're on the sidelines right now, I think just do nothing. I would simply, if you're fortunate enough not to be in a margin kerfuffle like I am, just sit and wait. I really wouldn't go long right now. The risk reward of going long up here is it's horrible. But on the same side of that coin, or the other side of that coin, going short right now, I mean, it probably doesn't hurt to put a tentative short in. But having said that, I have to be completely objective here. I put a tentative short, two tentative shorts in down here, and look where that ended me up. God, my speaking skills is dreadful. Is dreadful. So I think that's it there. Let's have a look at the chat box. Someone mentioned about bot trades. Let's have a look at some bot trades.